Hi traders, welcome to another edition of Trading Tips brought to you by howtodoubleyourportfolio.com. We'll talk to you more about how you can take advantage of howtodoubleyourportfolio.com at the end of this message, but make sure you check out the website, click on any links that are below the video, and I'm sure you'll love what you see. Anyway, today we've got an action-packed session for you, and one of my favorite topics are the charts. We're going to explore moving averages today and talk to you about how you can utilize them both for upside movements, downside movements, and obviously setting price targets, stop losses, and really just viewing a trend of just about any stock or index out there. Moving averages are a very important part of what we do as traders, and a lot of traders choose to ignore them because they're maybe steeped in fundamentals, maybe you're a little old school, but I'll tell you this, if you ignore the technicals, especially moving averages, you might be putting yourself behind the eight ball. So why do moving averages work? Well, you got to remember, it's not just a bunch of lines on a page that make these things work. Friends of mine who are anti-technical analysis believe that it's impossible that some lines can predict where stocks are going. But when you think about it, hundreds of thousands of traders around the world have been taught these methods. They are taught to look at certain moving averages, and therefore their beliefs become reality. It becomes essentially a self-fulfilling prophecy when you have not just traders, but programs and algorithms. Think about it. Think about the world of trading today. Most of the market, a lot of the volume that you see today is driven by computers. Now, those programs were written by the hands of man. So a lot of times when, stocks are getting really volatile, it's not just people reacting, but these are sort of computer programs and algorithms pushing these stocks to certain levels, especially if we see a major moving average violated, which again, I'll talk about in just a second. Traders use these moving averages really to determine different sort of time frame trends. In other words, you're going to be looking at like a daily chart if you're focused on maybe shorter term to intermediate type trends. You can look at maybe a weekly or a monthly chart if you're looking for longer term type trends. But I'll tell you this, for most of you guys out there who hold stocks from anywhere from a day to maybe a month or 2 to 3 months, you could do a lot of your work within the daily chart. Okay, and I'm going to show you that in just a second here. And remember, it's also important that there are a couple different ways you can use moving averages. Okay, you can look at the relationship of the stock to the moving average itself, and then the different moving averages in relation to one another. And lastly, don't forget to look at volume. That's one of the things that a lot of pro traders even forget to view. Volume is the cause and price is the effect. Without volume, without people coming in and buying or selling, stocks just aren't going to move. So what are some techniques that we can use? Well, for shorter duration trades, and again, anywhere from 1 day and really to 1 month or 2 months, I want you to focus in the daily chart, and I'll show you that in just a second, and you're going to look at the 20, 50, and 200-day moving averages. And you can look back, and I recommend you look back at least 6 months or more, preferably a year, to establish trends. And again, you're doing this within the daily chart. And what I mean by established trends is get an idea of what the stock tends to do when it breaks up above a 20-day moving average or breaks down below a 20 or 50-day moving average. The good thing about historical data is that we can get an idea of where a stock has been, and that gives us a clue as to where the stock is going. Okay? Keep this in mind too. When a stock is above its 200-day moving average and the 50-day moving average is above that 200, then the stock is generally considered to be in a bullish trend. Obviously, if the stock were to fall below that 200-day moving average, or if the 50-day moving average were to dip below the 200, which again, I'll show you in just a second, that is a bearish trend. And typically, you got to be careful if you're buying stocks with those sorts of chart formations. And lastly, violations of the 20, 50, and 200-day moving average are more severe as they get bigger. In other words, if a stock breaks below the 20-day moving average, it might move down 1%, whereas if a stock breaks down below the 200-day moving average, you might see 2, 3, 5, or even 10% sell-offs. And again, that works the opposite way too if a stock is actually climbing. So let's take a look at some of the examples I've got here. And here's the S&P 500. And in this case, we're just simply using the method of when the stock crosses the 20-day moving average, we're focusing on shorter term trends. That's going to be our buy or sell signal. So let's look at this first buy signal here where you see the first green arrow on your left. You can see the stock breaking up above this green line, which is the 20-day moving average. There's that rally. Okay, now again, if you were using just the moving averages here, you would hold until the stock crossed back below the 20-day moving average, which occurred here where this red arrow is. That would be your exit point. You really don't have another entry. You might have gotten a little bit of a head fake here, but the next real entry comes right around here. Again, stock breaks up above. It confirms it by staying up above it. And let me explain this. When a stock crosses up above or down below a moving average, what I like to see is the stock close above, in this case, above that average. And at that point, once we have 1 day of closure, that would be my signal. So the reality is I might pay a little bit more, but at least I have confirmation that the stock is moving in that direction. That way you won't get this head fake like you saw back here in late June of 2003. Again, next red arrow, that's our sell signal. And you can see it really works here. There's our sell signal. The stock sort of trails off. You have actually another little bit of a buy signal here, which you could choose to heed if you'd like. But again, you get the general idea of just using the stock crossing above and below the 20-day moving average. Now, if you're using the 20-day, this is generally good for, let's call it a couple days to maybe a week or two hold times. Okay, the bigger average you work with, for instance, if I were to use the 50, I might be willing to hold the stock for at least a month. If I'm using the 200, which is all the way down here, this red line, I'm going to be holding on to the stock for a longer period of time. So again, the longer the duration, the more severe the movement, and also the longer you're going to be in the trade. Most of you guys should be focusing between the 20 and the 50-day averages. Let's take another look at a different stock here, LinkedIn. Now, in this case, we're going to use a different technique. Both are fine. This is just another method that some traders use. In this case, we're monitoring how the 20-day moving average crosses the 50-day moving average. So the rule is when the 20 crosses above the 50, that's our buy signal. So here we see the green line cross above that orange line. That's our buy. And as long as it remains above the 50, we remain in the trade, okay? And you can see here it gets pretty volatile. We actually don't get the sell at the high, but that's okay. We would sell at this point right here where the 20 crosses back below the 50. And that's a pretty nice run. This is a run from about, let's call it about $100 or so, all the way up to about 175. Not a bad run. Next entry point comes around about $178, right in this level right here. You can see my green arrow. There's the cross. And again, hold, 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 and then cross. The next crosses would be our exit point. And again, that's up around $240. So the methods work. The problem is a lot of times we don't have the patience to stay within the trade. But I'll tell you, if you test this method out, you'd be surprised at its efficacy. It's pretty impressive. Last but not least, let's take a look at a bearish trade. Again, real important here. Here we have the 200-day moving average. This is IBM, obviously a very volatile stock here over the last year. I want to point out something that's really important. First of all, you have the 50 crossing above the 200. And you can see the stock was a mess here. It was falling off a cliff. But look how the stock literally came right down to that moving average and then bounced. This could have theoretically been used as a buy signal. Okay, but in this case, you sort of had a lot going on. What I really want to point out are the sell signals. Again, first warning might have been this green 20 crossing below the 50. That might have been the point where you say, hey, you know what? This is getting ugly. Where it really gets ugly and where we enter into a bearish trend would be back here. And by the way, this is back in August of 2013. The 50 fell below the 200. The stock was around $198. And look at it. It just continued to struggle. We had some rallies, sure, but the stock, even today, traded all the way down to $172. So the bottom line is moving averages are extremely powerful. When used correctly, they can be on your side, and they can be effective tools in getting into, getting out of, and setting support and resistance levels for your trades. As we move forward in this educational series, I'm going to talk more about moving averages and some more advanced techniques and how to use them. But for now, the key is this. Remember, watch for major violations of large moving averages. If your stock falls below the 20, 50, or 200-day moving average and you're in a bullish trade, you might want to consider an exit. Also, don't forget that if the 20 crosses below the 50 or the 50 crosses below the 200, those are also signals to move. Also keep in mind, a close below or above a major moving average with a continuation the next day or 2 days confirms that violation or breakout. Remember, just because a stock gets above a moving average, you want to see it close there and then the next day continue in the direction it was going. That's our confirmation. And lastly, don't forget, watch volume. If you're in a trend that you want to continue, you generally want to see volume at least stable. If you're in a bullish trend and the volume's tapering off, that could be a problem. So guys, that was our trading tips for today, and I urge you, check out our website now, howtodoubleyourportfolio.com. Again, you can get a copy of our new ebook entitled with the same name, How to Double Your Portfolio Value every year. And again, howtodoubleyourportfolio.com. Find out why this strategy is 28 times less risky than buying shares of stock, and how you can profit even on expensive stocks like Google and Apple. So again, check out howtodoubleyourportfolio.com. I'm Jared Levy. Have a great day.